Hello, it's Richard Bowser here from Property Investor News magazine. Today I'm in Westminster at the Great Buy-to-Let debate, which has been sponsored and organised in conjunction with Paragon, the lender, and Shawbrook. I'm here now with Professor David Miles of Imperial College, who has just delivered a keynote speech at this particular debate and also participated in a panel debate. Good afternoon, David.
Hello, good afternoon.
David, you've made some very good points during that commentary. Could you just amplify your points about the marketplace being distorted now against the rented sector and the implications therefore?
Well, I think the recent changes in tax, that is the increase in stamp duty tax that you'll have to pay if you're buying a property to rent it out, plus the limited ability now to deduct interest payments at your marginal income tax rate if you're a private landlord, make the system even more distorted against rental supply. I think the system was already somewhat distorted because of the tax system. Obviously, people with buy-to-let properties will pay capital gains on any gain. You don't pay that if you're an owner-occupier and it's your main house. Furthermore, of course, rental income is taxable. That the income that people implicitly receive as owner-occupiers is untaxed. So I think the system was already somewhat distorted against rental supply. That's getting significantly worse because of these two changes. I think it's an unfortunate move.
Yes, and on top of that, obviously, apart from the taxation changes, we've had the recent PRA, Prudential Regulatory Authority, changes towards lenders, and there are obviously consequences there in terms of lending criteria.
That's true, and we'll see how that plays out. And the Financial Policy Committee at the Bank of England now has some levers it can move if it thinks the buy-to-let market is overheating, and it's not clear yet quite, how they will use them and how that plays out. What we do know, unfortunately, is these tax changes are coming into effect, and I think they have a very substantial impact. I've estimated that if you're a private landlord and you're affected by both these tax changes, stamp duty and the income tax, so you're a higher rate taxpayer and you've got a mortgage, the rent that you receive on a property would need to go up really quite considerably to compensate you fully for those and leave your after-tax rates of return the same. So that might mean that a private landlord might need to see the rent rise by as much as 20, 25, even 30%, depending on their position and how much they borrowed. That's a big change.
Absolutely, and there have been a number of comments made since the changes came to be announced, the 3% stamp duty, and obviously with George Osborne's announcement initially about what became Article 24, Section 24, which is now obviously starting to kick in from this April and sort of take place over a sort of 3 to 4 year period. So there will be a gradual weakening of individual landlords' position in terms of the amount of tax that they're going to be paying in the years ahead. We've also heard here today from David Whitaker that we're seeing a much greater percentage of landlords now incorporating for new purchases. Do you think that's the trend that's likely to continue?
Well, I think with these tax changes, it makes a lot of sense if you can to become incorporated. Of course, it's more of a problem in a sense for people who've already built up a stock, and simply switching from being a private landlord and moving the property so that you become effectively incorporated is a potentially quite costly process. In particular, because you may have to generate capital gains, which will then be taxed. So there are some pretty substantial obstacles for moving the existing stock from being affected by these taxes to not being affected.
David, thank you for those comments. Do you, without obviously a crystal ball, do you think government will actually sort of change their mind in the next 4 or 5 years on these changes?
I think it's hard to say. I think that the recent white paper that came out just a couple of weeks ago on the housing market in general had one rather optimistic aspect to it, which is that it was, if I may say, rather more neutral on tenure between renting and owner occupation than previous governments had suggested they favoured. I think until very recently, the government, and indeed previous governments, had given a strong impression that they thought that owner occupation was a far more desirable tenure for people than being in the rented sector, and that therefore they should worry a lot about the recent decline in owner occupation. And I think that really was absent from this white paper. I think that's a hopeful sign.
Yes, yes. Thank you for those comments, David. In terms of the interest rate outlook, if we just sort of summarise ahead, obviously this has been probably quite a strong a reason why house prices, particularly in around London and the southeast, with a more stronger economy than some other regions, and people feeling more confident to borrow more, it's been a key driver of house price growth in recent years. What's your take on the potential interest rate changes ahead? And I appreciate this is a real crystal ball question here.
Yes. Well, look, I think it is highly likely that at some point in the next few years, we begin the slow movement back to a more normal level of interest rates. Obviously, bank rate at 0.25% is not normal. It's still, in some sense, an emergency setting, even though we're, 8 years or so after the financial crisis first hit in September, October 2018. So at some point, I think we will get back to something a bit more normal. Now, of course, we used to think that normal was bank rate of, somewhere 5-6%.
Yes.
I suspect that is no longer the normal. The Bank of England has been pretty clear that it takes a view that the new sustainable normal level of interest rates is not where we are, but probably isn't back at the 5-6% level. It may be a number, somewhere between the two, 3% or so, maybe slightly under 3%. So I think we will start that journey back to that more sustainable level. I don't think that's something that we should be terribly worried about. In fact, it would be a sign that the UK economy had finally, healed itself after the, wrenching disaster, really, the financial crisis. So I think if it happens in a slow and gradual way over a period of a few years, which I think is the most likely outcome, I don't think there's something here that we should be terribly fearful of. What would be more worrying is if in a short period of time, the Bank of England felt that because of the way the economy was going, they really needed to get back to that level of interest rates in a very short period. At the moment, I don't think that's particularly a likely outcome. Inflation is going to move up a bit this year, 2017. But I think the idea that inflation is moving back up to very high levels that the bank will have to counter with very high interest rates, at the moment that seems to me extremely unlikely.
David, thank you once again for your comments. So it's Richard Bowser here with Professor David Miles of Imperial College at the Great Buy-to-Let debate in London, Westminster.